And welcome to ETF Edge, your go-to place for everything exchange-traded funds. It was declared dead a year ago, but now the 60/40 stock bond portfolio is making a comeback. I'm your host, Bob Pisani, with yields on two-year treasuries now approaching 5%. Bonds are becoming serious competition for the stock market, and single treasury bond ETFs are seeing big inflows. Let's talk with Alex Morris. He's the president and CIO of FM Investments. Also joining us, Dave Naudick, financial futurist for Verify. Alex, everybody wants to buy two-year treasuries. I was at a party over the weekend at my family's house. My mother asked me about two-year treasury yields. My brother-in-law asked me. Now you know it's really seeping into the zeitgeist. 6 months ago, you launched a series of single bond treasury ETFs, 3 months, 2-year, 10-year treasuries. You've now got a 1-year treasury. Tell us how these work. What do you get when you get, just pick a 2-year treasury bond?
Sure.
What do you get?
So you get just that, the 2-year treasury. And you'll get the on-the-run treasury. And that's an important distinction because every month the Treasury Department issues a new 2-year bond. So eventually, 24 months later, you get your money back. We stay on the run. That's the most liquid of those issuances that happen, and it's the one that you see quoted on TV.
And every on the run simply means that every month there's an auction, a new auction for a 2-year treasury, and you roll over the old one into the new one.
Correct.
Okay. Dave, last year at the ETF conference, I mean in 2022, the 60/40 stock bond portfolio was declared dead by everyone. This year, there was a very lively debate. You were there about whether it was back and to what extent people should roll into bonds again. In addition to my brother, I mentioned my brother-in-law asked me this weekend about putting all his money into Treasury bonds this weekend. Something is seeping into the zeitgeist here. When your mother asks you about 2-year Treasury bonds, are bonds really becoming serious competition for stocks? And if so, what's this mean for stock market rallies this year?
I think they absolutely are becoming a significant competitor to stocks, frankly, to any risk asset. I mean, you talk about the 2-year, look at the 6-month. Right now, the highest yielding part of the curve is buying 6-month Treasury bills. That's nuts, right? That kind of inversion, first of all, is something we haven't seen in a long time, and a lot of folks are concerned about the recessionary impact of that. But that inversion speaks to this belief that we're going to have continued increases in the rack rate by the Fed. That puts us in this position of having to really evaluate the risks of bonds coming down because of increased rates, or looking at what's going on in the stock market, where we're seeing some potential for margin compression. I think there's plenty of concern to be had on the equity side. I've actually talked to a lot of advisors who are a little concerned that the short-term story here may be actually both the principal value of your bonds and your equities coming down, as we saw last year for most of the year. That's a recipe for pain. But on the short end of the curve, you get paid very quickly, right? I mean, if you put in money in a 6-month treasury, you're getting almost a 5.25% yield on that. You're going to collect 2.5% of that in just 6 months. That's incredible.
Yeah, that will ease the pain a lot, Alex, right? I mean, stocks down, bonds down 2 years in a row. That would be a really bad news story. And yet it is ameliorated a bit by the fact that you're getting almost 5% on a 2-year yield. Where does this all lead to? I'm asking a 30,000-foot question here, but what is the right stock bond allocation now? Is the 60/40 dead? Suppose you're 40 years old. People message me all the time. They're 40 years old and I have a moderate risk tolerance. Should I own any bonds? I don't know. The market seems to be voting, saying yes, clearly.
So I don't know the exact right split, whether it's 60/40 or 70/30, but there should be a healthy allocation to bonds. It shouldn't be just treasuries. There should be corporates. There should be a well-diversified basket of it. But for today, it seems that a healthier dose of treasuries makes a lot of sense. Why would you not take a 5% coupon in 6 to 12 months? Yeah. It just seems to me, if you were looking to get long-term, say 8% out of that 60 equity percentage, and you can get that today out of a bond portfolio with no risk, seems like it's a good trade to make.
It seems like a no-brainer for a lot of people. You know, Dave, I see very large inflows into short maturity Treasury ETFs like Alex's and to others, including the Spider ones and some of the iShare ones. But not as much interest in longer maturity bonds like the 10-year ETF, or even I don't see as big inflows into corporate treasuries. Maybe you do. But why is there so much interest in these very short maturity treasuries right now?
Well, very simply because we know interest rates are going to keep going up, right? I mean, currently the market is pricing in 3 more 25 BIP increases There's plenty of folks out there thinking that may even be late. We may be even looking at a percentage. You don't want to be in TLT or the 20-year long bond if you know that you've got a 1% interest rate hike coming, because that's going to come right against your duration. And that's what duration means. So it's not surprising at all to see folks really allocating towards the short end of the curve. But the interesting point here is if everybody was doing this, we wouldn't see the rates that are as available as they are. So this is a rare opportunity. I don't think we're going to be looking at an inverted yield curve where you get paid more to own the short end than the long dated end for a significant amount of time. I think that lasts for maybe 6-12 months tops when we get to a terminal rate.
Well, that's a good observation for either one of you. Why are yields this high? I mean, if the demand is really that high, why wouldn't yields be lower, Doug? Dave, excuse me. Why wouldn't yields be lower at this point? I don't. You brought up a good point. If the demand is so strong, and my mother's talking about it, why aren't yields lower?
Well, I mean, some of it is really, I think, the long-term asset allocation problem, right? So most folks who are sitting on cash don't think about getting into the 2 years what they're doing with cash. They look at something that is extraordinarily short-term focused. And in fact, you'll see that that part of the curve, the 1 month is actually a little bit lower than, say, the 6 month right now. And that's that hunger for cash. This belly of the curve, sort of from the 6 month to about 5 years, is where there seems to be a real opportunity for real investors, to capture some value without taking some of that duration risk of looking at the long bond. It is worth pointing out that the long-term bonds did pull in good assets so far this year, about $15 billion so far, and things dated over 10 years. But that's pulled way back in the last few weeks. We've seen in February. And to your point, everything's about the short term as we're heading into March here.
And I was hoping you can comment on this. I mean, the fact that we're still seeing the interest is in the very shorter term maturities, not in the 10 years, and not even in corporate so much. I'm even seeing outflows from the high yield stuff, like the Spider high yield J&K. There were outflows recently. So this is not some let's go buy bonds across the board. It's a very specific type of inflows, at least in bond ETFs that we're seeing.
Sure. I mean, I think it makes a lot of sense for a bond buyer, particularly first-time bond buyers, who are probably some of the folks we see today, to want to have no credit risk, which is what treasuries offer, and to have the maximum yield they can get. And so everyone is piled in. Plus, the government has been very willing to issue bonds in that category with reasonably high coupons, because that's what the auctions have required them to do. Yeah. Now, I wouldn't abandon long bonds in the long run, right? Once we do hit a terminal rate, there will be some capital appreciation abilities there. And the U.S. 10-year Treasury still remains one of the most liquid securities ever. It is what sets mortgage rates to car loan rates to all of other long-term liabilities. Yeah. So you will see a resurgence in that eventually. But for right now, if you can get a free lunch at 5% in 6 months, investors have voted with their dollars and they're taking it.
Yeah. Can you explain why we need an ETF to do this? I mean, one of the points people bring up to me all the time when I talk about these inflows is, well, I can go buy Treasury Direct, I can buy government bonds online directly. What do you get when you get an ETF? Is that a structure that's desirable to own short maturity treasuries?
Sure, so we think so. It's also why we're launching 6 more to help people do this. But at root, what you get is the bond that you expect to get. But I encourage others who want to buy it on Treasury Direct or who want to buy it through the brokerage firm simply to try it. It's hard. There's no ticker. You need an 8-digit QSIP. I hear Dave's laughing because I made this pitch to him 6 months ago, and I think he had the same response, but I'll be curious to hear if he's changed his thinking.
Well, the obvious point here, to fill in your thought process, ETFs trade intraday, too, as well. And there's an advantage of it, and it is confusing. Dave, I wonder if you agree with this. I actually did this. I went on a big brokerage site and tried to buy the 2-year a little while ago, and it is confusing. There's 24 different QSIPs, I think, just for the 2 year.
You can do it.
It's every month.
It's not impossible. It's just
no, but it's
complicated.
Confusing.
It's confusing. If you go right now to your Schwab or your Fido account and you say, I want to buy the 2-year, they'll quote you a maximum yield to maturity right now of something hovering around 5%. When you go to click buy, what you're going to see is a dozen QSIPs. And those are going to be everything from the last on-the-run 0 that they published last month to some piece of paper that was a 15-year note a long time ago and is now expiring, in that window that is a 2-year treasury. So they all end up getting repriced the same. So from a notional notional perspective, you're going to end up pretty much in the same bucket. But it's not the case that you can just simply click a button, get the exposure of the headline rate that you're reading in the Wall Street Journal or seeing on CNBC. It doesn't work that way. It is much more complicated. And if you're an advisor, you're actually probably paying more than an individual investor for the privilege of doing that. And heaven forbid you want to do something like rebalance on the 15th of the month. Now you got a whole nother world of pain.
So, but I want to get back to the point. Do you agree with the idea? Can you make a case why we need an ETF structure? Like, why do we need a 2-year ETF
because the bond market
going to?
Yeah, because the bond market is effectively a by appointment market to start with. In this case, you can make that appointment with Treasury Direct, right? You can go directly to the source and maintain a separate account over at Treasury Direct, which is probably where you've got your inflation bonds and those things too. It is a terrible process that is rife with opportunity for user error and miscommunication. It's very gross in the sense that you're working with large chunks. You're not being able to do precise rebalances or precise allocations of individual dollar amounts. You're at least buying $250 blocks, if not 1,000 or more. All of those things make it just frankly inconvenient and often more expensive than just buying a 15, 20 basis point ETF that's going to do it for you.
Well, there's a good point. Alex, you charge 15 basis points.
15 basis
right?
points.
And can you make an argument, Dave, as an impartial observer, that it might be worth it to pay those 15 basis points?
I would go so far as to say that while I am not personally invested in either of these funds or directly in bonds, if I was trying to get an allocation for the 2-year, I would not be going to Treasury Direct. I'd be looking at a product like this or at competitors that are starting to come out offering similar kinds of exposure. But if you're an advisor, again, it may actually be monetarily cheaper to get your exposure this way than to be trying to manage the individual costs of your platform.
Now, I'm trying to think of play devil's advocate here. Isn't the issue, if I were to buy your 2-year ETF, I'm getting it on the run. So right now, this month, it might be 4.8%, but you're buying on the run. So the yield will change depending upon the demand, right? So a year from now, I might not still be collecting a 4.8% coupon. I might have a different coupon. Whereas if I bought it directly, I'd be still having that 4.8%, right? Or roughly that.
That's right. So the on-the-run nature will force us to rebalance every month, which is good because we stay liquid, but has the downside of you get the current reset rate. But when rates do reset and, say, go down, the price of the bond will go up, so your holding and the amount of bonds we can buy for you will go up. So you'll still have some total return impact of doing this versus buying and holding a bond.
Yeah, that's a good point. You're about to launch some new ones, right? You have 6 new single bond ETFs. Tell us about that.
Yeah, so similar to the ones we have today, which look after the 3-month, the 1-year, the 2-year, and the 10-year, we're going to fill out the rest of the yield curve. So you'll see the 6-month, the 3-year, the 5-year, the 7-year, the 20-year, and the 30-year come out. And it's really been just an answer to market demand. Folks have asked us to give them a full rates tool set, so when the yield curve shifts, they can shift along with it, and we're going to give the people what they've asked for.
Dave, does this story have legs? I mean, the problem with bonds is they don't sort of have the narrative power of equities necessarily. We have stories behind equities and, personalities. Bonds don't have that kind of narrative power. But does this story have legs? I mean, for example, people have asked me about preferred bonds. Ford's paying 6.5% for their preferred bonds. Yeah, that's been a terrible performer this year. I don't know I'm trying to figure out what the right narrative is to construct around the bond story this year.
I think the narrative is I really would come back to the issue of diversification, right? The reason that you own something more than a single ticker in your portfolio is because you don't want that exposure to single issue blow up risk, whether that's a treasury bond that gets repriced because we have a 1% surprise increase, whether that's the global economy tanking or whether that's an earnings recession. You don't want to have all your eggs in one basket. So bonds have always traditionally been that zagging diversifier when equities zig. I would actually say this is a fantastic opportunity for folks not just to assess their stock bond ratio, but consider the role of other counter-correlated assets they may have, whether that's the equity in their home or a managed futures product.
I would agree with that. Would you, Alex? I mean, he just made a simple point. Diversification is key. So you want to have a diversified group of assets, real estate, stocks, bonds, commodities. I collect rock posters. I always say to my wife, she says, "You bought another stupid rock poster?" I said, "It's not a stupid rock poster. It's a diversified asset. And I get away with a lot with that. With that line, I get away with a lot. Honey, it's not a stupid Jimi Hendrix poster. It's a diversified asset.
Oh, that's right.
Actually, I show her that as part of the portfolio.
That's smart.
And she says, oh, yeah, that's good. You're talking to Dave too much.
I don't think you can get that into an IRA, though. That may be a problem.
I'm working on a separate, a classic rock portfolio ETF.
But I think the answer is yes. I mean, look, we do this for a living. We trade bonds, but we own other assets as well. And we encourage everyone to seek financial advice because what's right for one person isn't right for everyone else.
Yeah, good advice. And this has been a fascinating conversation, folks. Remember, when your mother asks about a 2-year bond, there's something going on here. That does it for this week's ETF Edge. My thanks to Alex and Dave. We've asked Dave to stick around for the ETF Edge podcast right after the show and give us his broad perspective on where ETFs are going this year. And remember, you can see all of our shows. It's on the website, folks, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.